Good afternoon. My name is Jack Moriarty, and it is my esteemed pleasure to introduce our first afternoon panel on the topic of bridging the gap between institutional investment and employee ownership. And I'll offer two very quick thoughts before passing the baton. The way I've sort of thought about this, and we had a great lunchtime conversation around this, is there's sort of two conditions you need, right, to sort of expand and scale this field that we all know and have come to love. The first is, and we talked about this yesterday, you need a whole bunch of legislative, regulatory, policy strategies to take what is right now a niche and turn it into a multi-trillion-dollar asset class and really scale this all sorts of different employee ownership models across the capital markets, both here and around the world. But that doesn't happen without really the first condition, which is you need the pioneers, you need the innovators, you need the early adopters that can collectively show us the art of the possible. You can't scale what you don't know. And that's why I'm so thrilled to introduce a panel of friends and a great subset of these entrepreneurs and real leaders in the field. First, Ted Marguerite, Managing Partner at Paraline, Catherine Toner, the Managing Director of Impact Investing at Gary Community Ventures, Lindsay Zizumbo, Executive Director of the Sorensen Impact Foundation, and Allison Lingane, the Founder and CEO of Ownership Capital Lab. I'll let Allison take it away.
Thank you, Jack, and thank you so much to everyone for being here, and again, to Maureen and Joseph and everyone involved in bringing these last 2 days together. It's been a really powerful set of conversations, and I think we're going to have another powerful conversation here today. So, capital is such an important lever of growth for employee ownership, and if you look back, we certainly wouldn't be where we are today if it hadn't been for all the ESOP lenders who have really helped with the growth of the ESOP space. If it hadn't been for the CDFIs who've really leaned into the co-op lending and the new EOT lending, right? We really depend upon capital in many ways to have gotten where we are today. And there's this new set of employee ownership funds that are looking to work with capital in different ways, and those funds need to be capitalized in a much greater way. And I truly believe that is a huge lever of growth for us as a space if we can capitalize. This earlier today, we heard someone say we need to be thinking about 10xing. I believe we need to be thinking about 10xing and then 10xing again, right? And then from there. So, and we can do that with capital, and we're going to talk a bit about that today. So my name's Allison Lingane, and I'm the founder of Ownership Capital Lab. You may or may not know me previously from my role as co-founder of Project Equity, but really what we do at Ownership Capital Lab is we work on that lever of capital. For growing the number of new employee owners that we believe is possible in the United States. So what we want to do now is just ask each of our panelists to introduce themselves. And I'm going to ask, as you do your introductions, if you can also have some brief commentary on, if you do look back 5 or 10 years, how the employee ownership space is different, so that we can be thinking about the next chapter moving forward. And then also, the framing of this is institutional capital. So unpack that from your perspective just briefly so that folks in the room who may not be familiar with that lingo can get a sense. So starting with you, Lindsay.
Thank you, Allison. Catherine and I figured out how to turn on our remotes, so I feel like we're already successful today. I'm Lindsay with the Sorensen Impact Foundation, and it's great to be with you all today. I can't look back 5 years because I've only been here for about a year, so thank you for Joseph and Jack and other folks in this room who have really helped us come up the curve really quickly in employee ownership. Our foundation is really dedicated to moving more capital into the impact investing space. I know that feels like a broad mandate, but impact investing is still in and of itself a nascent space. And so we've spent most of our time with that broad mandate. But every once in a while, a theme comes across that really checks across many verticals all the impact boxes for folks. And as Margot said, across different programs and streams of capital. And for us at the foundation, that is the ownership economy, and specifically within that, home, community, employee, helping Americans own where they live, where they work, and a stake in the capital markets is incredibly important. And Last year, we put out a request for proposals for funding for both philanthropic dollars and also catalytic dollars, and it was the first time those two teams had ever worked together. A success in and of itself. For those of you who work in the foundation world, know how hard that is. Margot's laughing. She appreciates my pain. And I know Catherine does as well. So as I think about the context of where you were 5 years ago, I don't know, but I do know you're having your moment, and there's a lot of new capital at the table. And there's a lot of capital still sitting on the sidelines. We've got to get off the sidelines. Our subtext at the foundation is pioneering the gap, or helping folks through the valley of death. That is the role of foundations and family offices and high net worth individuals that care about impact and that care about impact allocation and where their dollars are going today. And if you ask me, there's not a better place for those dollars to be going today if you care about decreasing the wealth gap. So I'm excited to talk about those things and how we can sort of bridge that gap to institutional capital and what scale looks like for folks, because we're excited to see all the employee ownership funds and products that are out there get to scale.
I'm next. The microphone's working. We did a really good job. Yeah. Catherine Toner, I'm with Gary Community Ventures. We're a hybrid family office private foundation based in Denver, Colorado. We very much have a place-based mandate in Colorado for our philanthropic work, but have a national portfolio and are uniquely 100%, not necessarily uniquely, but we are both 100% impact invested as an endowment, and we are also a sunset organization. So I will be out of a job in 10 years. I always make this joke on panels, but I'm serious. I will be in the job market. But no, it's a very cool structure, one that I moved to Denver, sight unseen, to support, because it really changes the way that we're able to take risk and think about risk. And I love the term, be that kind of bridge in the valley of death to real market rate and scalable solutions. Employee ownership, which is kind of emblematic of, for us as well, kind of that structure that is both producing market rate returns and implicitly creating impact for the folks that help drive that value in a company itself. I get to uniquely do a lot on the investment side. Two of our investees are here, Tarana Group Central Owners Fund, as well as Apis and Heritage in Fund 1 and Fund 2. And so really learning through our portfolio what structures work, how to actually implement on the ground from the people doing the work, and how structurally that kind of translates into value and wealth for the employees. And that fits in our broader strategy of, I oversee our family economic mobility investment portfolio. And we view essentially the P&L of the family and the balance sheet of the family as the things that we want to affect. So increasing income, decreasing expenses, and increasing assets. And employee ownership is very much in that asset bucket, and thinking about ways that can be generated through housing value, through home ownership, individual assets, and now employee ownership and other structures in real estate. So excited to talk to you all today.
Great. Thank you, Catherine. My mic's working as well, so we're off to a good start.
You got it.
Well, good afternoon. First, it's been such an honor to participate in this important conversation. It's been so inspiring today and yesterday to hear all the great ideas, the excitement, not just in my space, the ESOP world, but across employee ownership, things I wasn't even aware of. It's just so powerful. So I'm Ted Marguerite. I'm the managing partner of Paroline Capital Partners. We're a bit of a unique animal. I've been in the ESOP space for coming up on 20 years. Throughout that period, my role has been advising business owners as they've evaluated ownership transition, ESOP primarily, but not exclusively. Our role at Paroline, where I founded Paroline 2 years ago, was to expand the awareness of employee ownership. And that takes two forms, and we have two parts of our business. On one hand, where we spend, frankly, most of our time is advising. And that's going to find business owners, whatever they want to do, whether it's sell to private equity, do an ESOP, but we want to put that ESOP option on the table for them and make sure it's considered. Educate them on it. It might not be the right solution. It's not the right solution for everyone, but we want to make sure that they're making an informed decision. So that's the first part of that. The other part of how we want to bring those market-based solutions is by connecting capital. One of the things, and I'll come back to this in a bit, is that the capital markets in the ESOP world, and within the ESOP space, we focus on companies valued over $100 million. So large businesses, I think last time I looked, our average client had several hundred, 300 to 400 employees. At that size business, they have a lot of options. And for better or worse, the price of entry to that conversation is what is a minimum level of liquidity that they can pull out? And so how do we bridge that capital gap? And we think the way to do that is using an ESOP, bringing market-focused investors, and having them invest in alignment in parallel, hence Paroline, in parallel. That was pretty clever, wasn't it? ChatGPT does amazing work in COVID. Yeah, it was phenomenal. Also ChatGPT. But bringing that together, because we're staunch believers that when structured correctly, investors can realize great returns, particularly great risk-adjusted returns, and at the same time deliver phenomenal outcomes for owners and communities and employees. And so that's what we do. So, Allison, back to your question. What have I seen over the last 5 years? I'm going to go back even further, probably. So as I look back to, call it the early 2011, 2012 timeframe, I have seen the explosion of private capital to the extent that I think private equity has just simply run out of things to buy, and that's leached over into the ESOP space in that it's just increased the level of expectations that business owners have, and it's made ESOPs harder. I'm looking around the room at some of my fellow ESOP practitioners. We all know that, let's say pre-2022, we sold more ESOP companies than we instituted new ESOPs. Why was it? Because private equity had a lot of money and they were offering. That, I think, tide is changing. Higher interest rates will bring multiples down. Private equity is realizing that they probably overpaid. That's creating an opportunity to have more, I think, compelling ESOP conversations. But I think we do need to figure out how to bring more institutional capital on a sustainable market-based basis into this realm if we're going to grow ESOPs at scale. And that's what we set out to prove.
Yeah, love it. That's super helpful to get your perspective, especially from the ESOP vantage point, because we've been having so many conversations about ESOPs in the realm of the sort of the normal way that ESOPs are created, I would say, versus maybe some of the newer ways where we've got these funds that are kind of going shoulder to shoulder, if you will, with private equity funds, bidding on these companies and transitioning them. So appreciate that. So we're going to go back to you, Lindsay, and you talked about the pioneer gap and the valley of death, and in our space of the dedicated employee ownership funds, you mentioned Fund 1 and Fund 2 for APIS and Heritage. We have 2 Fund 2s. So for those of you who are in the investment landscape, that means that every one of our funds in the space is an emerging manager, right? So from your vantage point, could you talk about some of the ways that you can pull on the levers of what you have, but also sort of the call to action about the ways to support and really lean into getting off the sidelines or supporting these emerging managers, whether they're in their Fund 2 or their Fund 1 or even just getting organized?
Yeah, absolutely. I think investors spend a lot of time trying to understand and perfect models before they invest, and we all know that employee ownership can be a really hard learning curve. I know that's been true for us as an investor and other investors that we talk to. But the reality is it's not that complicated. And especially if you care about impact from an emerging fund manager or a first-time fund manager, there's quick boxes to check there. But I think we do have to continue to break down the education barrier. We have to break down the data that exists. We have to get that out and have more transparency in the market. I think that's a big problem. But from my vantage point, foundations can play a really unique role in supporting the ecosystem and sort of the different scales of capital or spectrum of capital that exists and are at our fingertips. So, we put out a request for funding last year, and we did it for both our catalytic investment portfolio and also our philanthropic or grant bucket. And that was the first time our programs had talked to each other, but it also became aware of how much grant capital needs to go out to the space. And I don't think we're seeing enough of that capital in sort of this niche early learning stage, so that folks like the Aspen Institute and their incredible work, or Transform Finance. A number of folks that are sitting in this room are doing, Rutgers, others that are doing this incredible work behind the scenes. We need to see more of that grant capital go to the learning, academic scholar work. On, specifically to the funds and the fundraise, as we've had, we were one of the first investors in the A&H fund, in early 2019, and so excited to see them in, raising their second fund. We have a lot of funds in the space, and we have a lot of new capital that needs to be raised in order for these funds to succeed. Jacob said something to me earlier that was great, which said, don't tackle the bear in the cabin first, not the bear in the woods. And I think it's incredibly important that the funds that are in the market now are successful. If they don't raise the capital needed at this time, it's going to be a failure to launch in this space as far as an investor sees it. And so whenever we have investors on the sidelines that say, how can I get involved? Where should I start? I'm like, get off the sidelines. Put capital into these emerging fund managers, put them into fund 1, put them into fund 2. There's 20, however many, Allison knows this. 27. She knows the number of capital that's being circled, which is more capital than's been raised for funds in the employee ownership space.
670 million if all of the funds are successful with their raises, compared to a base of only 500 million of assets under management right now in the specialized employee ownership funds.
So double.
More than double.
More than double. Our work's cut out for us. So I tell folks all the time, this is one way to think about this, is a private credit strategy. Get off the sidelines, see the impact, see the return potential, and get in the game, especially as foundations are concerned. I think Margot and I are always on this soapbox beating this drum. A lot of our friends are still sitting on the sidelines. So I spend a ton of my time trying to help investors get off the sideline. But a lot of this comes from an education gap and understanding all the different structures that are out there and which ones work better and which ones don't, what size the company have to be, so all those learning curves. And then I think from an investor standpoint, there's some innovation that can happen. I think there's an entry point that could be made easier so that there is capital ready at the employee conversion place. So whether that's a fund-to-fund model, so people can start to dip their toes in investors. I think there are different ways that we can play, but I will say no matter which place your capital is coming from, there's a lot of capital needed on the philanthropic side, on the catalytic side, and as we move these funds up to the market rate side, we've just got to get off the sidelines.
Love that. Get off the sidelines.
You're already off it. So tell me what's next.
I hate sidelines.
You were not a bench warmer, were you?
Yeah, so tell us, Catherine.
I was JV lacrosse, but, we can talk about that later. It's a lot of emotional trauma.
So tell us what you're doing, not being on the sidelines. Talk to us about some of your investments and what you're learning and seeing about the gaps and the needs, and how at sort of the field level, what the needs are in order to unlock more capital flowing.
Yeah, I think I agree with Lindsay on the grant side in understanding the learning, and Joseph has been working for decades, and Jack on the actual data behind the performance and efficiency of the underlying portfolio companies under employee ownership models, and that is a commercial rationale we need the data basis for to get institutional capital at scale into these investments and in asset classes across employee ownership investments. And I think that's a big thing for us too, is just the framing of this as institutional, like to attract institutional capital is not I'm investing in employee ownership or this is my impact strategy. It's like, no, it is a private credit strategy that fits into our endowment portfolio strategy and asset allocation, that the underlying investment and value creation is employee ownership itself. And I think that framing is really powerful for our investment committee and for also getting folks off the sideline and getting the traditional CIO endowment folks at foundations to think about this as more traditional asset allocation and not a niche, fluffy impact strategy, because it's not. It's a large driver of value in the workers that are creating that value day to day. I think grant capital is also incredibly helpful at the firm building level. But Lindsay and I were talking about this earlier. The danger of too much grant capital is creating that label of impact only or impact first. And there's certainly an area and an opportunity and a need for that type of capital and the catalytic capital to bridge that valley of death. But institutional capital long-term in employee ownership strategies requires a very market-oriented approach. And so we're supportive of that and supportive of funds that are both experimenting like essential owners in different structures that are not necessarily full ESOP conversions, as well as full ESOPs structurally, but the underlying credit or capital being provided into those investments and conversions are traditional asset classes.
Yeah, fantastic. I love what you said about we need to show up with the investors in the way that they are used to being pitched, and instead of saying I'm an employee ownership fund, say I'm a private credit fund. Oh, and the value creation happens through the employee ownership. I mean, it's the same thing that the funds are experiencing in the space of being able to go to a business owner and say, instead of, oh, business owner, you should fall in love with employee ownership. No, go to the business owner and say, oh, business owner, we have capital, we want to acquire your company. Oh, and P.S., employee ownership is the added value that you get by going with us instead of by going with the other firm.
And is the captive buyer at the end of the day. Like, once the ESOP is set up, and I'll use A&H as a example.
He's not even here for this panel. We keep using his name.
Damn it.
Rude, Phil and Todd.
But a unitranche strategy is you're essentially approaching the seller who has run the company and put their blood, sweat, and tears into it and providing a mezz debt and a unitranche senior debt opportunity to achieve the end goal. For an EOT, for equity comp, for any broad-based structure, it is a dividend recap. Like, speaking in the real terms of traditional finance to communicate what this actually is, I think bridges that gap and goes a long way to make this a normal, niche investment strategy.
Yeah, and what that takes is the marrying of folks who have backgrounds in investing and can speak that language with folks who have backgrounds in employee ownership, right? The two have to come together. So over to you, in your experience, especially on the sell-side advising on the ESOP front, tell us more about what you're seeing and what you touched on this in your opening remarks, but what you see as some of the paths to more institutional capital.
Happy to. So I think the biggest challenge we have in the ESOP world today in terms of institutional capital is twofold. As we speak to investors currently that are invested with us or people who are evaluating the structure for the first time, structurally, they love the idea of ESOP, but that's like third or fourth on the list. Number one is, how do you generate returns? Why is this differentiated from what I'm doing today elsewhere? Okay, check that box. But where they struggle as they understand the structure is duration. And what we struggle with in the ESOP context is, and I'm ESOP specifically, but more specifically, 100% S Corp ESOPs, because that tax savings helps generate the return that the investor is looking for. That duration to get their capital back is long. We always say it's 7 to 12 years. That is a hurdle. But I would say even more so than that is the dearth of institutionally investable businesses. How many businesses over $100 million that have the reporting and the controls internally and the management team to actually warrant institutional capital out of the 200 some odd ESOPs that are created every year? I'd pull some of the ESOP folks in the room, but I think we would all agree it's probably less than 15 or 20. That is the single biggest hurdle. Now, how do we address that? That network of buyer, if you own a $200 million business I'm from South Dakota, so I'll use Sioux Falls, you're going to think that private equity is the only option. That's just fundamentally how you're going to think, unless you're thinking of some sort of gratuitous transfer via ESOP or employee ownership. That is what needs to switch. But what needs to switch is we need to reach that party, that business owner, before they engage the middle market investment banker who's just incentivized to sell them to private equity. Because those companies exist, those owners exist, but we need to get them before they already went to a different asset class. And that's why we think it's so important, and what we're doing at Paroline of our sell-side business is that gets us in front of those people first before they go to auction. I don't want to invest. I don't want to bring my investors into an auction. You know, the person that wins the auction is either the smartest person or the dumbest person, but they are certainly the person that paid the most. So if we can get in front of that, not only do we have the ability to educate them on an ESOP before they're already down the path somewhere else, but we also have the ability to create really attractive structures and returns for our investors without the impact of that competitive auction.
I'm going to quote that.
That's copyrighted. You can quote it. There's
I'll
a licensing
attribute.
fee.
I'll
Yeah,
attribute.
it's
I'll
complicated.
attribute.
The smartest or the dumbest, for sure. So that's actually a good segue maybe into the policy arena.
Oh.
But let's talk state policy in Colorado. And, have you share a little bit about the good things that have been and are happening there in Colorado, and then, what you'd like to see happen at the federal level?
Yeah, absolutely. And I'm looking at my friend Jack over here, who has been a conspirator. Yeah, Colorado is ripe ground for employee ownership. We have two of A&H's Fund One portfolio companies there. A lot of activity, a lot of support from our Office of Economic Development. We are one of a few states that have an employee ownership office, have a cash collateral program for financing that applies to employee ownership conversion transactions. And in this session, Gary helped develop legislation that essentially provides the first state-level economic incentive to convert to employee ownership. So taking kind of the 1042 rollover approach, but applying it to state income tax, essentially capital gains exemption for employers and sellers that are converting at least 20% of their business to a broad-based employee-owned structure in order to qualify for that capital gains exemption. So as you can tell, I'm very much like the traditional finance evil capitalist version, and like really wanting to narrow in on what economic incentives, and I think you probably agree with the need for this in the S-Corp 100% ESOP conversion being a large driver of returns, but how can we replicate that in other areas and other structures in order to incentivize behavior that doesn't rely on just the goodwill and the big heart of sellers. We do live in a capitalist society, and I think have to design for that. And so it's an experiment. It passed with great bipartisan support, as we are not surprised in the last 2 days, out of the first two committee hearings that it went through, and then appropriations is next week, and then I'm learning about the legislative process. I'm like, I have office hours with our policy team. Yeah, it's I feel very, very silly, but it's exciting, and there's tremendous momentum and support at the state level, which I think is ripe ground for testing for national and federal scale.
Awesome. Can you share about the cash collateral as well?
Yeah, the Office of Economic Development and International Trade, OEDIT, in Colorado, is administering a cash collateral program as it's designed, or as it implies, that it was originally designed for small business lending at the state level, but explicitly has been expanded to use in employee ownership conversion financing. So essentially providing additional collateral and reducing the need for personal guarantees from sellers in order to attain the financing for broad-based employee ownership conversion. So kind of as the call to action institutionally as catalytic capital, I think more ways not only to support the mezz funds and the folks actually doing and leading the conversions, but thinking about ways that you can use your balance sheet and more traditional philanthropic and impact investing structures to support the senior lending piece to de-risk, quote unquote, because it's like a very attractive cash flowing assets that we're talking about, but
Perceived risk
to bridge to that institutional CRA oriented senior financing world. So
cool. So yeah, so the cash collateral is basically you go to a bank to get a loan for your ESOP or other employee ownership transaction, and there's not enough collateral based upon what the bank requires to say yes to that loan. So the state is stepping in to fill that gap in order to get the bank to say yes.
to get, yeah, well, they would say yes at a very high interest rate, and so it's a lot of the pricing control to eliminate that perceived risk as it's represented in the rate of return that you'd have to pay.
Yeah, love it. That's great. So, comments on policy. What are your thoughts? Do you have anything you want to share?
Well, we share a border. I'm in Utah and she's in Colorado, and I just have to say we have a lot of work to do. We're nowhere near that in Utah, and I would suspect in other states as well. So I think the state lever is a really good one, interesting one to pull. We've been pulling it on home ownership, which has been much more successful for us. So hoping we're just starting to educate legislators on that front. And on the federal side, Jack's getting lots. I'm going to give him a mic. Is there an extra chair? We're going to pull him up. We have worked with Jack for years at Lafayette Square Institute, and he's doing incredible work on the Employee Ownership Investment Act. I got it a little wrong, but it's getting renamed anyways, I think. So, and that's a great program that will, once passed, move a lot of capital into the space. I continue to think from this side of the house, we've got to pull all the levers, policy included. And so the more grant capital or whatever capital is that you have that we can support in that area, the better. And that there's an education gap there as well. I think that's probably all I have. Jack, what did I miss?
Any policy asks that you would have from the seat that you sit in?
My biggest concern is I don't want to lose what we have. I'm a big believer in we have the tools. We need to use the tools better. And we need to demonstrate better outcomes for investors. Because I know one thing, if they're earning attractive returns, we will get a flood of capital. And if I look out 20 years, my goal is I want to make ESOPs the same, it's from a market acceptance perspective as private equity LBOs. There's no reason they shouldn't be. But we got to have real returns. We got to have good outcomes. And if we can do that, I think the capital's going to be there and the demand will fix itself.
Love it. All right, so we're going to go to Q&A, but before we do that, are there any just sort of quick thoughts you guys want to share with the group here before we move to Q&A? Catherine, to you.
Anti-sideline, I think, is just the
Use my bear in the cabin analogy.
Yeah.
From Jake in the back.
bear and the smartest or dumbest person. Yeah. I'd really just want that to be the takeaway. But yeah, I would say just this is a moment to take risks, and risks that have data to back it up and support the field that continues to support that for that actual bridge to institutional capital. We need to get to a place where every pension fund sees the inherent risk of the underlying companies and support and safety net of those companies or lack thereof as a existential risk that they can mitigate through their portfolios and their investments and put a high volume of capital into these strategies that are sustainable and produce market rate returns. And that's kind of it. Like the impact piece is wonderful and important, but to get to that institutional scale, it requires a real market-based and market-oriented messaging and approach.
Yeah, I would add one thing, which is what we're seeing is that it's working. So our investors are single-family offices, couldn't spell ESOP before they heard of us and met us. I love that because these are real investors that are investing for returns. And when we bring them opportunities, they've been very excited. And actually now what they're doing is they're saying, hey, we want to invest more money in Nebraska, a live example. And so we turned around and said, okay, let's go find companies in Nebraska that are family owned, that fit the profile of what this investor is looking for. And let's go ask that owner. Hey, I'm sure you get private equity offers all the time. We're not that. We're going to talk to you about an ESOP, but we're also going to talk to you with the perspective of having a checkbook. And those conversations have been really productive. And so turning that around and saying, instead of us, invest in us, we'll go find some generic opportunity, but we're actually going to our LP saying, what do you want to invest in? Let us proactively go pursue that. In the ESOP angle, the reception we have with business owners is so different than talking about a private equity sale. It's resonating. And so I think it is working. I will say the one thing I note as we go more truly institutional investor, in the pension world, They don't know how to benchmark employee-owned vehicles. They have no idea, are you a debt, are you equity, who do you talk to, how do we deal with you, how do we know if you're doing good or bad? To me, that's actually probably the biggest hurdle as we seek investors, is they like the concept, they feel good about it, they see the return potential, but they have no way to benchmark us.
Completely agree, and I think that goes back to the messaging point of it's not an employee ownership strategy. This is a private credit strategy. This is above market rate debt for a dividend recap, so you can convert part of it to an employee-owned structure to align interest. And I completely agree, and I think that's a huge messaging issue that we collectively can solve.
Love it. All right, Lindsay.
Yeah, I would just add that, I mean, as we know, times are incredibly uncertain, but luckily employee ownership is not one of those issue areas that is hard to sell on either side of the aisle. So as investors or foundations or other folks are sitting on the sideline,
There it is.
this is a safe place to play. And I urge capital allocators to get out there. Yes, you said they're mostly emerging fund managers. That doesn't make these structures high risk or haven't been diligence. These are incredibly good vehicles to invest in with really strong fund managers with really strong track records. Since Phil decided to grace us with his presence, I'll call him out specifically. As we know, A&H is one of those. And I'll just come back to hearken on my drum again from the beginning, which is we've got to support those that are in the market now raising capital. This is our time when we look back in 5 to 10 years, we want to say that those funds that are raising more than double the capital that's under management now survived and made it. And those proof points, were proven. And then we moved our way all the way up into the market rate capital where someone doesn't have to have 95 LPs. They've moved to a market rate place with bigger checks and, proof points. So that's just my call to action yet again.
That's great. So one quick comment because we want to have time for questions. Go ahead.
My quick comment, Lindsay, I wanted to follow up on one thing, and that's in these uncertain times, we have to remember that employee-owned companies don't have equity. So if they hit hard times, there is going to be opportunity for investors to provide that equity to let those companies weather the storm. And I think as we think about capital in this space, it's not just instituting new ESOPs. We have to support our ESOP companies through downturns. And we're talking to LPs about that right now.
That's a great point.
Okay, so does somebody have a mic for questions?
We've silenced the room.
Nobody wants to be the smartest or the dumbest.
Yeah, hi. I think a question. Catherine, you were the one who mentioned EOTs. And there's a lot, the ESOPs have obviously been around for longer. The S-Corp conversion tax advantage strategy is really well known. But EOTs seem brand new. Can you just say a little bit more about your perspectives on those? I'm David Rolfe, by the way. I chair a pension fund with about $450 million of assets under management in Seattle.
Excellent. Look forward to your investment in several of these vehicles. I think we view at Gary EOTs are one of the tools in the tool chest. I think we've talked to or alluded to a lot of tribalism in this space, and I talk about it very blatantly because I think we need to focus on the big tent. An EOT and the trust structure and the perpetuity underlying a trust structure is the right opportunity for some businesses. Obviously, very new, but we do have it sits under the perpetual purpose trust umbrella, and there we have a few more data points. But the governance piece is a significant piece of that a lot of strategies in the ESOP world integrate, but does so very intentionally just through its legal structure. So broadly see it as a tool, a structural option, and in our legislation is listed as one of the options that would qualify for the capital gains exemption.
And it's not new in Europe. It's very well tested in Europe. Mm-hmm. Yeah.
Ted, you kind of answered my question, but I'll answer it anyway. Maybe others have comments. But we've heard over the last couple of days that awareness, lack of capital, and policy, those seem to resonate all the time. Those that know me, I'm all about the awareness every single day at the Employee Ownership Expansion Network. I've always often worried that the more capital that's there, do we have enough companies in the pipeline to do that? You've made me think of in a different way. Does more capital actually help with the awareness? And the reason I say that is you're going to business owners and bringing it to them. I guess a comment there. Do you think more capital improves the awareness?
Yeah, I think at the end of the day, business owners, they want to do the right thing by their team. But that's second to, I want to make sure I get a fair deal. And so the more capital that we have demanding that, that opportunity, you're going to create awareness because they're going to hear about other success stories at other businesses. It's sort of, where private equity was 30 years ago, and why private equity took over the world is everyone realized that they could sell their business for way more money than they thought it was worth. And so that happened because capital was available. So I think capital will create awareness, but at the same time, we do have to make sure we can deploy it because, Lindsay, to your point, I think, it's great that we have people out fundraising and raising funds, but there's a lot of pressure to deploy. And I mentioned this over lunch to my table, but we have to be very careful as a space that when we deploy capital, that we're actually generating attractive returns, because if we get known for creating substandard returns, that is going to be very difficult to come back from.
Does either one of you want to comment on that question?
I mean, I'm not the smartest person in the room, but I couldn't have said it better.
Yeah, great.
Lindsay, I really appreciated you talking about source and kind of quickly moving up the learning curve. And I'm curious if you could talk a little bit about the internal kind of stakeholder management and education that you've done to be able to get the decision makers at Source and comfortable and excited to step in this space.
Yeah, thank you. How long do you have? No. I mean, I kid. We started as a single family office, and I think while Jim Sorensen is renowned as one of the earliest impact investors, so he's not been hard to convince in any innovations in this space. We do have folks on our board and investment committee that are a different story, including his own children who came from private equity, and their first reaction was, if they can't sell the deal to private equity, it's not that good of a deal. So that was a real challenge for us. And I think all of us deep in this space find that offensive now. But, we went on a learning journey together. There's nothing, an impact investor loves an entrepreneur, right? That's what gets them into the space, gets them excited. So we took the people to the ground, and we've done that with legislators in different states. You pull up a list, you call Jack and you say, Jack, how many employee-owned companies are there in Utah or in Colorado or whatever state? And he can pull a list, and you go visit those, and all of a sudden, you're not only on the ground seeing the heartstrings of these companies, but you also call Phil and you say, give me some of your data, and he's got it. And Joseph just came out with new data that's fantastic. It's there. And so it's simply just taking them on a hearts and minds journey that equals, matches sort of a return expectation and what their, sort of their risk appetite is. And when all of those things clear out of the dust, you see what a great strategy this is. And I'll say it again, to Catherine's point, we look at it as a traditional portfolio model within our investment strategy, and that's changed as well. But one thing I wanted to say earlier too, I've never seen investors be so willing to share diligence as they have been in this space. I've begged folks to send me their diligence, and I've worked with Donovan and other folks and Springpoint, and they're just, everyone's openly willing to share investment memos and diligence in this space, which is incredible. You don't see this in other investment verticals. And I only bring that up to say, Margot said it great earlier, we need every stakeholder at the table for this movement, and I think everybody is here for that. But as investors, I think our job is to reduce the knowledge or the coming up the curve. And we can do that by creating new investment products that make moving capital into this space easier. And I think that's on us to do. And I hope next year when we sit at this, we probably won't be invited again because we were just,
No.
But if we are invited here again, hopefully what we can do is share what some of those models look like, because I think we want to remove how long it took us to take this learning journey.
That's great. And so I'm going to close us out now just to follow up on that and say, one of the things that we do at Ownership Capital Lab is I see it as table stakes in our space to do the sense-making work of what is the employee ownership investing marketplace. What are those opportunities, creating spaces where investors can come together and share due diligence with each other, educate each other. So hold those spaces and advance those conversations in order to be able to invite more investors into the space and really encourage them to get off the sidelines. So one of the things I do want to say just before we wrap is that at Ownership Capital Lab, we are launching an initiative over the course of 2025 to develop a roadmap for employee ownership capital in the space. And you may have seen sitting on some of the tables, we've got some postcards with a little QR code that I would encourage everyone to take our survey. And you can get to it at tinyurl.com/EO Capital Survey. But we're really asking everyone to help us map what it is that we should be doing as a field and as a space to be very intentional about continuing to grow the capital marketplace for employee ownership, continuing to get those investors off the sidelines, continuing to support our emerging fund managers so that when we say in 10 years and we look back at this time period, we say that was an inflection point. We saw a flow of capital coming into the space that really changed the growth trajectory of employee ownership. Thanks everyone for joining us.